Good afternoon, Facebook. I'm Jill Malandruno, Global Markets Reporter at Nasdaq. And since it is the first Friday of the quarter, that means Eric Balchunas, ETF analyst for Bloomberg Intelligence, joins me at the market site for Trade Talks ETF Fridays. There were some amazing trends in ETFs the first quarter, but before we get to that, let's quickly review some equally impressive stats. For Q1, Nasdaq had 7 new listings from 5 different issuers. We now have a total of 333 products listed from 39 unique issuers, an increase of 38% compared to this time last year. So with Eric, we're going to see what ETFs exhibit the strongest momentum, starting with semiconductors, because they have been a contracting factor in Nasdaq breaking through all-time highs, which seems like what's happening on a daily basis. So let's talk about the semiconductors, because that's really where the momentum has been.
Yeah, so semiconductors are on another level. We run this momentum screen, and we look at the last 12 months and the last 3 months, but excluding the last month. That way, any mean reversions gets kicked out. So semiconductors scored high on the list. But here's the thing with semiconductor and the ETF, that SMH and XSD are the 2 tickers. They also scored really high on the 5-year momentum, which is, that's not necessarily a good thing. Because if you look at long-term momentum, stuff that's been up for 5 years, it tends to reverse. So semiconductors are sort of defying gravity by showing both long-term and medium-term and short-term momentum. And look, we have a good product cycle for semiconductors, and there's definitely a reason they could defy gravity. But I would say that as a cautionary note here is that typically if something shows 5-year high returns, it tends to not return well over the next 5 years.
So you don't think that it's going to continue to outperform?
Like I said, those are just 2 mixed messages in momentum. So it just, every single thing that has momentum, there's usually a couple good things about them, but there's always something that you need to pause with. There's no sure thing, right? So that's the thing with the semiconductors.
Outside of semiconductors, there's been some real improved regional performing in Brazil, for example.
Yeah, Brazil. Now that's one that has been horrible for 5 years.
Right.
So I think you like that. You want to see something that has a lot of room to run, not something that's just been like this for 10 years. But Brazil has just been crushed. They had when their last leader, when she got impeached, that definitely caused some beginning, and then there's been some good central bank policy, and so it's up 40–50% in the past 12 months. It's exhibiting, when you rank them, the most momentum of any country that we track. So most people use I think it's EWZ, but it's the iShares Brazil, which is the one that has like 90% of the volume and assets in that area.
Right. Well, let's talk about negative momentum leaders. And I don't find it a surprise to see that the vol-based ETFs are leading the pack in negative momentum.
Yeah, there's a caveat to that. Yes, they are. It's interesting, right? Trump is arguably pretty volatile, but volatility has been flat since he won. It's been nowhere. In fact, VIX has gone down like 20%. But VIX ETFs, which have to use VIX futures, they also have the roll cost kicking in, so they're down 40–50%. So their negative momentum is a bit extra because of that roll costs, but they still are, VIX, even if you took the futures out of it and just looked at VIX, it also has negative momentum. It's just down in the past 6 months. And honestly, VIX has been really low for a long time. I mean, whether that's the Fed environment, we were just looking today at the inverse VIX products and how well those are doing. They're up 1,000% in 6 years, but just by shorting VIX futures has been really the trade of the decade up until now. Although when that reverses, it can be really bad.
Right. Well, what other negative momentum leaders are out there?
Look, I have to be honest with you. I don't have the list in front of me. You had VIX. I think there was another one on there that was poor performing. Might have been silver miners, although gold miners is on the flip side. Gold miners have been doing pretty well. Gold is interesting. Gold is showing momentum, but so are equities. Normally, you wouldn't think those are together. I think what's interesting that we're seeing is that investors don't want to miss out on the equity rally, but they also find Trump, they're a little nervous with him, so they want to hedge at the same time. So what we're seeing is flows into both equity ETFs and gold, and they're both going up. And so we find gold miners and junior gold miners have been on a tear, and they also have been crushed over the past 5 years, so they have plenty of room to run. And considering the world we're living in and what happened last night, you could see that gold as a crisis hedge could be have upside going forward.
Right. I mean, we saw that again too, where the S&P 500, for example, and the futures on the overnight, we were down about 20 handles. We actually opened up green. But we also saw gold up as well, so that's a great example of how they're running in tandem with each other.
And let's just say, I get asked this a lot. How do I hedge the stock market with ETFs? People think gold is a hedge. It's not. Gold is sort of like a rebel. It does whatever it wants. It has zero correlation to the market, not negative. So that's why, gold might not go up in a crisis. In 2008, gold was only up 3%. Long-dated treasuries are a little better of an inverse correlated hedge than VIX and those kind of derivatives work. But gold is up this year, and maybe you didn't expect that. So gold kind of just marches to the beat of its own drum, and I think it's an important thing to point out. It's not necessarily always a hedge.
Right, well, let's look at some value leaders, and I think we should look at the insurance ETF, because a lot of questions that I'm sure you get asked is, how do you participate either from a speculative or hedging perspective with insurance rates potentially going up another 2 times this year?
Yeah, so insurance companies came up as a value play. I think the price of the book is 1.5 or something, maybe 1.1 or something. That's low, because the S&P is 3. So we're talking it's priced half as much or more than the S&P in general, and it really is about rates. There are solid, we have an analyst that I work with, John Adams, who's a great insurance analyst. He says the fundamentals are pretty good, the companies are pretty strong, it's just rates. So if you like that value play, you sort of have to think rates are going to go up. If they were to go down, then you could obviously see something going down further. But if your rate outlook is going up, insurance companies look really cheap relative to the rest of the market.
All right, and let's talk about the rise of passive investing, especially through ETFs. There's an argument out there that it's creating a stock market bubble. That sounds like a very one-sided argument to me. Of course, money managers are going to say passive investing is creating a bubble, or you're not getting, the bang for your buck.
Yeah, I've been hearing that a lot. The metaphor I like to use is blaming the stock market bubble on ETFs is like blaming the MP3 for Nickelback. Okay, the ETF is just a conduit to express an opinion, right? So if you look at, what really is, first of all, is there a bubble? Let's just assume you think there is, right? The markets are showing high valuations. S&P's about 20 PE. The Fed was definitely a big part of what drove people into equities. Then Trump, and then earnings. Those are the things driving people in. The other factoid I'd like to point out about the bubble and ETFs and all this is ETFs still are a drop in the bucket. They have 1.4 trillion in equity assets, right? Equity ETFs have that much. The equity market is 26 trillion, so they own about 6-7% of equities. So it would be difficult to think that they are really causing a bubble in multiple ways. I think where ETFs get this sort of outsized vision is because they trade so much. They represent 30% of the trading volume every day, whereas stocks represent the other 2/3. So they definitely are being used so much that it seems like they own more than they do.
All right, now let's wrap it up with this. CNBC's Mad Money host, Jim Cramer. Now, he's my old boss, formerly for 5 years, so let's watch how we phrase this. But he claimed that ETFs are holding your stock hostage. Is there any merit to that?
Not really. Look, I think that, again, if you look at the ownership of Apple, right, 6% of it is owned by ETFs. So, honestly, could you really hold anything hostage if you own 6%? Right. Let's throw passive in there. You throw passive accounts for 13% of Apple's ownership. So even at 13%, I don't know if they're holding it hostage. And then let's go to, well, what does an ETF do with corporate governance, right? BlackRock and Vanguard, which make up the majority of that 13%, have corporate governance departments. So they are holding these companies accountable. So they're not exactly, neutral players or bad players. They're trying to push forward ESG, keep boards independent. So they're actually, I think, alongside of any stockholder. They're not necessarily, they might not be like an activist investor, but they're trying to push companies to do the right thing for long-term value. So on multiple levels, I think that's a little bit of histrionics.
All right. Well, thank you very much for joining us at the Nasdaq, as always. And we'll be back with you in July. A lot can happen between now and then.
Looking forward to it, and the warm weather.
There you go.
Yeah.
And thank you, Facebook, for joining me as always. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.